All right, hey there guys, Sam here. I'm back with another video in our little series we've been doing here. This is kind of a combination of both of what I would call our underappreciated indicators, and then a combination with the indicator that you've seen be used. It's one of the first things I put on every chart, which is our initial balance indicator, but using it in a different way where we can focus on the opening range breakout or the ORB technique, which is very, very popular amongst futures traders. And I think perhaps with some demonstration, you would see some value here as well. So let's start though with the daily gap fill or unfilled gap indicator. Same difference. Now let's be clear, right? I've got a micro MES here and a 5-minute chart here, which I would recommend for everything we're looking at today. I think the 5-minute bars are most suited to this. Now, of course, you could just bring up a chart as I have here. I think I've got 14 days of the RTH pulled up here, and you can identify the indicators doing it for you. But if I took that off, of course, you could just do this. You could just say, okay, well there's the gap. Oh, actually, I guess it would be a little higher up here to get this precisely. So okay, so there's my unfilled gap from one day to the next. Now, you could do that, of course, right? So that you'd essentially accomplish the same thing, but you're going to be missing a lot of the data that would be really important to any trader who's statistically minded to see whether or not we can get some edge from this information. So out of the 14 days, we have 9 trading days here. So just looking at this data here, this is really meaningful. So of the 9 days, the 9 trading days, the gap was filled within one day, 89% of the time, with 3 up and 6 down. So we can look at that and say, well, obviously there's a very, very strong tendency for the market to want to fill these gaps. You can think of a gap, really, it's an imbalance, right? You can think of it like a fair value gap. That's what it is. It's an inefficiency. That's the way the algos will see it. It's an inefficiency. It's a gap that the market is going to want to come back and fill in, right? To fill in that inefficiency or that price gap. So every day you could look at that as just, well, hell, I've just got a giant fair value gap here, right? Which the market is going to want to likely, right? Again, the market's never obligated to do anything. It's just these are very, very strong tendencies. 90% of the time, that gap is going to be filled within one day. And then additionally here, we can look at the size of the gaps and see what percentage is filled and filled within one day. Well, of course, here with all of these are filled within one day, right? We have all of our gaps here. It does look like there was one that remains unfilled, but again, it's meaningful for even up to a 25-point gap. A very high percentage that's going to be filled. Time, right? This is additional information that's tied to the unfilled gap indicator or the daily gap fill. Right? I'm just in the habit of calling it unfilled gap indicator. During the time period when they're likely to fill. So between 9:30 and 9:45, 33% are filled within that window, right? So here's a pretty good example. We had a big gap up and then just the market comes right back down and fills it. So we can look at these. Again, this is just statistical data that can be meaningful and useful when we're looking at a gap. Okay, here's one that ran away from it here. This is Friday. We ran away from the opening gap here. We didn't fill it until tail end of the day, but we filled it. Again, it's an inefficiency. The market's going to seek to the algos, right? We're all trading against the algos. The algos are going to seek to fill that, right? So it's a strong tendency for the market to want to rebalance that price inefficiency. So let me just take that off for a second and let's look at this in a little bit of historical context. So certainly here, I mean, this was pretty amazing. This was Thursday. So the yellow here is the open, and the green down here is when the gap is filled 100%. So we open up here, and it's a pretty much of a little pause here. We go straight down and we fill the gap, right? We fill that mode right as the IB is forming, the initial balance being the first 60 minutes. So we open up here and then we just drop down to fill in that big inefficiency here, fill it. Now in this particular case, we carry on. Let's go back another day or two and we can look at some of these. Here's another one. We open down here. It's just a straight line up to fill the gap, right? The market wants to fill that gap, right? So that's something to consider whether or not you're prone to be trading within the first 5, 10, 15 minutes or not. Understanding, you see the market open here and we just go vertical. Why? What was there news? Not, or is it the market doing what it likes to do, which is fill in those inefficiencies? We go back. Now here's an example where we would want to be very cautious because the gap is so tiny, right? So that's not a day where this is going to be meaningful information here. Does it fill the gap? Yes, but that's not something that would be useful to you throughout the course of the day. I should mention here I have the prior day's open, high, low, and close on the chart as well, in case you're wondering what those lines are. Here's another one where massive gap up. We try to form value up here. There's no push higher, so that we spend the rest of the day working our way down to fill the gap. Again, would that be the only thing driving your decision making here? No, but it certainly might affect your bias, knowing that this remains unfilled. Now, there are times when it will remain unfilled, but sooner or later it's likely to get filled, right? Again, the market does not like to leave those inefficiencies, so you'll see this will be very consistent. Again, look at the times, look at the number of times that gap is filled. Back here, again, the range, right, is somewhat significant. Again, here's the open. We scream higher. There's no new buyers here. Whoosh, straight back down to fill the gap, right? Again, it's a very, very strong tendencies. The algos want to fill it. Here, I don't know what happened here. It looks like there's a little bug in the software here. I've lost a day. I'm not sure why. I'll have TDI Dev take a look at that. Here's another one. Here's the open, straight down to fill the gap. Right, and again, I could go through weeks and different markets here. The point I'm trying to show you is that this is a very, very strong tendency. Here, I'll do the same thing just for context here. I'll just switch this over to the MNQ. So let me pause for a second. Probably no surprise to you. You'd see something very, very similar in the MNQ. Again, over here we've got 9 gaps, 9 gap fills filled within 1 day, 7, 2 up, 7 down. Right, but they're all getting filled, right? And then we look at the range here. Even a 155 to 160 point gap is being filled within a day. So I wouldn't. I don't know that I would build an entire trading strategy around this, but I certainly want to be aware of it. So again, here's a remarkable example here, and here's a very small gap. But here we're opening up here, boom, straight down to fill the gap. Well, okay, there's a retrace, right? We get almost all of it right here. Interestingly, we swing back to 50% of it and then back down here. So you've got, essentially a measured move there. Swing, retrace, we get a new low here, and then the market is back, it's done its job, filled in that inefficiency. So off we go back into here. I should take that off here. I was getting a little ahead of myself. So here, down here, up we go. Same thing. Now this is small. Here we open, we go up, nothing, but then we come back down and fill it. Again, this is meaningful information, right? This is something I wouldn't want you to ignore. Same thing here. Here's this again. This is going to be very much like what you see with the ES. We open, scream higher, fill the gap. Tiny one, right? This has no particular value when the opening gap is that small. Oh, here's that little bug we have where it's missing a day. I'm not sure why we have that. Again, very small. It gets filled, but very small. We open, we go straight down, we fill the gap. So I think hopefully that I'm making the point there. Let me switch back to the MES. I'm going to go back and forth between the two. So let me pause for a sec. Okay, I've switched back to the MES here. Again, 5 minute. I've got a toolbar up here, right? Because I use that. That is the first thing I load on every chart by default. And then the initial balance indicator, I'm always going to add to any chart that I'm looking at. It's one of the first things that I add to any chart because I know how significant it is to algos and just in terms of how the day is going to play. But one thing that we've never really looked at in all the videos we've done on the initial balance is ways that we can work with the opening range. Now, the opening range by default in our IB indicator is set to 30 minutes. But many traders prefer to use a 15-minute opening range. And that is often, while there's no right answer to this. You could use 5 minutes, you could use 15 minutes, you could use 30 minutes, you could use the initial balance, you use 60 minutes. But for most traders, the 15-minute opening range it really has a passionate following amongst traders because it's very effective. So for those of you that prefer to wait for the first 15 minutes to let some of the noise of the market or the initial volatility of the markets open, let that settle. A 15-minute opening range can be very useful because we frame out that initial period of time, and then we can get some sense of direction based on how the market responds as it approaches the edges of that 15-minute opening range, or as it's often called, the ORB, the opening range. Breakout is the key piece there. Now, are we going to break out or not? Well, let's look at this in the context of adding to the unfilled gap, or the daily gap fill indicator. I have to correct myself all the time. To me, it's the unfilled gap. To the unfilled gap indicator, what could we add to this that might add some additional value? So all I'm going to do is turn on the initial balance indicator, but I have the opening range now set to 15 minutes. So let me turn this on. Okay, now we get some new context here that I think can be quite meaningful to a trader. Now, this is, again, keeping it just very rudimentary here. Note, of course, right, I've got an RTH session here. So I am conscious of the fact that I'm going to have a gap, and I'm not getting any benefit of seeing some of the overnight activity, right? Is there, how did the market respond to the Asian high and low? The London session, which would still be going until 11:30, but I'm losing some of that, which, okay, may or may not be a priority to you, but recognize that you're going to miss that bit of information, because you note here within the IB indicator, we have the capability to look at the pre-market session highs and lows, right? So that's something that you will often see in all the videos that I've ever done. But for this case right here, it's not relevant. So all I'm doing here is just identifying the 15-minute opening range, or or as would be used here, the opening range breakout technique, or the ORB. Okay, so let's just go to Friday, because this is a pretty good example. Now, one thing we have to recognize here is that this is a very popular technique. So thus, institutions, other traders, algos, will often look to take advantage of, they want to take advantage of breakout traders at every opportunity, because it's a dangerous way to approach the market. So if we look here, so here we get the opening range established right here. So let me get a cross here. Okay, so there's it's actually where's 10:50? There's 9:45, right? So I have it set right here. Now here I get this wick that pops up here, and you got to be careful of this. And if you ideally, right, we're going to add a little bit more to this. Note here that I've got, in addition to the very tight range here, I've got the opening range indicator here showing me that the gap fill is below the market here. So let's see if I do it. Let's do it. Let's get this off of here. All right, so I get this. Here's my opening gap down here. Well, we open here. I scream higher. Now, that would make you think, God, are we just going to leave this gap unfilled? Well, it certainly looks like that. Oh, maybe this is a breakout. Now, this is why this is I know, right? In hindsight, right, it always looks easy. But you wouldn't necessarily want to chase this just because we've broken that high without some additional context or confirmation, maybe very high volume. Again, I would want to see a close above. Now, personally, I would want to see a close. Now, here I get a close above, right? We get a different result. But this wicking up here and then coming back into the opening range would suggest, okay, maybe you took a trade here. If you did, okay, well, hopefully you had a stop on it, right? And you didn't take too much damage. It would come all the way back down to the open. And now that, of course, again, this is a tricky day by example. We come all the way back down to the open and we pivot. We don't get into any of the gap, which would confuse you, right? I was trading this, right? So I was watching this because I knew this video was coming up for the weekend. So I'm watching this going, God, the numbers here do not support the idea that this is going to be left unfilled, right? Statistically, right, this would be abnormal. Scream higher again. Well, it would be easy to think at that moment in time, guess we're going to leave it unfilled on a Friday, right? Somewhat surprising. Well, now here, this is an ideal setup here, and as we add a little more context to this, well, here we come back and we're just tagging the opening range, that 15-minute opening range, to the tick, right? And then we get pretty nice reaction here. So is there a trade there? Yes, right? Is this easier in hindsight? Of course. But it's the kind of thing to look for. So I've come here. The opening range gets set right here, right? So we see here the opening range is in red here. I've changed it to red so it stands out from the opening range itself. So here, IB high is the 60-minute. Now we know there's a very strong tendency for algos to fade the initial test of the opening range, right? We call that the Madonna trade, right? When it's a version, right? It's often, right, it will get rejected. So there's the push here. We get some legs, but there's no follow through, and we leave a double top up here, back down. Right now, here's the test. So here's the better trade of the morning is right here because we're retesting from above. We've broken the IB, we've broken the opening range high, and we've come back for a test. Now, as we launch from this, note we get imbalances on the way up. So there's strong indication here that this is a meaningful move. But again, we get up here, there's no follow through, and then it's ultimately it drifts over. Now, could you trade just off of this by itself? Now, I should note here I've got the default Wiseman fractals on here, so you've got two bars on either side to create a fractal, just in case you don't recognize that. Those are just fractals because these swing points will be meaningful to us. So there's an attempt up here after this swing and retest. There's a push, but there's no follow through, right? Look where we are, right? It's 12:30. So not surprising, right? Without any follow through here, and again, as we add more context to this, this will start to, I think, offer some more clarity that there's a pretty good sell-off, and then, of course, you'll note here we get a big imbalance right here, right? So we get a big fair value gap here. We know the market is prone to want to come back and fill in that inefficiency of price. So here's the retrace, and that sends us all the way down to ultimately closing the gap. Right, there's one more push up right to the mid. Right now, would you be trading? No, this is not a particularly good time to be trading in the afternoon on a Friday. Many do, right? But after 11:30, rarely am I ever trading on a Friday. But there are times when it can be profitable. But here, this is just slop and a little sell off into the end of the week. Let's go back a day. Now, one thing that I will note here is I'm just continuing to work through this. Once the gap is filled, here would be a better example. I take it off, right? Because now I've got more lines on the chart. I don't need it anymore. Once the gap is filled, I'm going to take it off because it's not relevant anymore, right? It's done. I've identified that the gap has been filled, and I don't want these additional numbers here on the chart. So that's just me, right? You don't have to. That's just what I do. Here would be another example. Once it's filled, I don't need this additionally on the chart, right? So that's just me, right? I take them off, right? Just personal preference here. Here again, I don't want all of that on the chart here. This was a day where it really had no value. So let's just go back over here to this right side of the market here. Now I'll take it off here. Hang on a second. Here, actually, I think this will be faster here. I've got this set up over here. Here's an MES chart. Now I'm starting to add a little bit more to it, and I'm trying to reduce the number of our indicators on here because I want the focus to be on the unfilled gap indicator, the daily gap fill indicator, and the initial balance with the opening range highlighted here. Now I'm adding here, this is the up down, but this is native Ninja's up down. I've got an EMA on this. Now this is our version of Cum Delta. Ninja has, if you have the order flow model, the order flow version, they have their own Cum Delta. I do favor ours because I love the Bollinger Bands around the Cum Delta. You'll find that very consistently useful. So here's a decent example here. Now again, I've taken off the opening range because in this case here, now again I could just draw it, right? I could just do this and say, well, here's the prior close, here's the session open. Okay, right. So there's my gap, right? Again, I'm not trying to tell you must have these. It's a tool, right? It's an efficiency tool. If you had the choice, yeah, very useful. If you don't have the budget, the resources, or you don't care, again, you could draw it yourself, right? That's always an option. So, but if we back to the point here, if we look here, here's that little teaser. Here's that little teasing wick, right? It's a breakout here. We know, right, if we're sweeping a high, you got to be cautious of the potential that that's just a liquidity grab. And clearly, right, that's what happened here. But you can kind of see here as we go up here, if you're looking at the Cum Delta, there's no enthusiastic push. There's no aggressive buying up at the high. Now, these are 5-minute candles, so it requires a more patient approach here. So we're all the way back down to the open. Now, again, maybe an EMA would be useful to you here. But again, we recognize the gap is down here. There's the prior day's close. We know that's down here. Now, you don't have the stats up here to kind of lean on saying, well, God, what happens most days? But you know that that's an inefficiency in the market. It's likely the market is going to want to try and fill it if it can, right? And again, most times it's filled within the same day, right? 89, 90% of the time. Okay, well here we start to see some of the value of this opening range breakout. The safest way always is to take a push outside and then take the retrace. That's the safest way to do it. You're going to miss some, right, if you're doing that. There are some days where it's just going to go vertical, and you have to understand that. There's other ways that you could participate in that, looking for inefficiencies as the market is moving. But for this is just a textbook example. I mean, it's to the tick, right? So now, what's there, right? You're not going to get the tick low, but on the other side of the IB, so maybe you're getting it here, somewhere in this range. If we start to break here, well, okay, are you getting rich there? No, but you got, what do we got there? 20 ticks approximately, right? You don't know. This is certainly there's signs here. Well, there's no follow through here. But once we get on the other side of the EMA, that's likely a place. Now, I should note here, this is not 21. This is a 9 period. For a 5 minute, I switch to a 9. For a 1 minute or a 2000 tick, I use a 21. But for a 5 minute, I like a 9, right? It hugs it. It doesn't. Just, I think, a better fit for the higher time frame. Now here's the more interesting trade here. Now this is just highlighted here off of the high volume here, just a high volume bar that I've colored. But what's key here is we can see this big fair value gap, right? We see that inefficiency. Here's a textbook. Oh God, I can't script it any better than that. We come right back here to the underside of the 9 EMA in the fair value gap, and then that drives us all the way down, and that's where we fill the gap. Here's the prior day's close, so here's the close of that gap. And you see the volume kind of supporting that. Now we get outside of the Bollinger Bands, which is why I love the Bollinger Bands on the Cume Delta. You'll find it incredibly consistent when we get up above it here, or when we're on the other side of that's a 20-period moving average in the middle of it. That can be a great guide as well. And again, this is Friday, so here's the, we get outside of it. Now we're pushing back towards the center line, or the 20-period EMA, as we go back to the center of the opening range. So this can be quite effective. We can go back to another day. Here's a decent day again showing this. Here's the prior day's close. Here's the open. So we have a massive gap, right? There's the gap to fill for the day. Well, up we go, right? All the way come down to fill it. So this is a day where, now how would you know? Well, you've got some retracement here. You could be using a measured move tool like this. We're coming right to the 50. Interestingly, here's the algo target here, right? This is, of course, right. I don't know how many videos I've done on this, but hundreds. So, right. So here's 50 to the tick. Here's the algo target as we close the gap, right? So that's another thing that you might consider, not to digress into other indicators. You might look down here and saying, well, where's the aggressive buying, right? If I've got this big gap here and we're aggressive, right? Could be tied to something happening, or a data release at 8:30 again, right? We're bypassing here because I'm still RTH. We're bypassing any of that information that's in the overnight. We're just focused on this as it gives you a visual reference as to the gap itself, right? It's not necessary, but some people prefer that. So as I can see this, as I come down here and I get the break, it's break and retest. So I'm getting this kind of price action here. I'm down. Now I'm retesting back to the low edge of the opening range here. Am I getting any follow through? Are we getting back in, right? Are there signs that we're going higher? Well, there's not, right? Now you could use the EMA here as a potential location for entry here as we get an inside bar here inside of this bar. Here's the down candle. We get the break, right? You got, well, what do you got there? You're not going to get perfect fills here, and you can use our manual back tester and do some back testing on this yourself, right? So if we're coming back here, I mean, this candle here would probably scare you out. There's 20 ticks again. What's your contract size? You didn't get a home run there, but you got a nice little trade here. Now again, look at the middle of the day. All of a sudden, look at the 9 EMA. All of a sudden, we're back in. Now we going back in to test it. We go right to the 50%. So was this a particularly profitable day? Not necessarily. Useful? Yeah. Once I'm back into that opening range here, there's no particular opportunity. I think we can look here again, always easier in hindsight, but there's no particular opportunity where you'd be looking at these relatively narrow range bars, low volume, volatility, or the delta is not particularly aggressive one side or the other. It's just kind of a waffling is there a trend? Yes, but it's not particularly dramatic. And then we waffle into the end of the day. Let's see if I can get one more here. Another good example here. Here's the open. Here's the open, right? We go, well, let's see if I have it on here. Here's the open, and the IB high, the IB low, the open here, and we have a gap from the prior day. So here's the opening range here, our 15 minutes. We scream up, then come all the way back down to the open. Now here we're going back up again, and you can see it's not a dramatic push higher and then coming back to it, but we do get a drift here. We break the IB high. Now remember the first test of the IB high, that's the Madonna trade, right? I've been talking about this for 5 years. Here's the first test of the IB high, right? So it does not get any follow through. There's no aggressive buying here, so it looks like a classic Madonna trade, swinging up, swing down. But we don't get a lot of traction. We don't head back to VWAP. We just, well, in this case, we come right to the 9 EMA. So we not only are we bouncing on the 9 EMA, and in the context of the opening range high, as you see it over here, now we start to push a little bit. Retest to the IB. All right, so. Oh, here we could use something like this. You could use this as your stop. Here, there's our manual back tester. Something like that. Well, there's 3 to 1. Right? If you're in a 3 lot, okay, that's a decent trade. At no point were you ever threatened putting your stop here just below here, even if I move that just down a little bit, below these candles here, a touch below the opening range high. Well, you still got your 3% here. Again, with something like this, you have to be really honest with yourself, right? If you see something like that, if you got 1.5 to 1, and you see this, is that got you worried? It might worry you, right? So you're sitting right here. Okay, well, I got $142 on a 3 lot in the micros. As this looked like, all right. So or you're trailing your stop. A couple of different ways you could approach that. But that's another one you might consider. Now here's one where we have, again, I'm not going to go through the whole week here, but very narrow opening range, very narrow. So less useful here, likely to be breaking on both sides. So if I were to draw a volume profile on this, let's do this just for fun. You're very likely to be, come here. I can get it to run for us. You're going to see a perfect D-shaped profile here, right? There's no trend here. We're just pushing the value area high, value area low, value area high, value area low, and then at the end of the day, we do get this nice trend here that comes, somewhat out of nowhere. I don't remember what the reason for that was. It doesn't matter, right? So we can look here and say, okay, well, clearly now looking at the 9 EMA, we pushed up beyond here. Now, is it still relevant? That's the question you got to ask yourself. Is it still relevant? Well, I've had no particular benefit as other than I'm going value area low, value area high, value area low, and then I'm pushing up here. Now, when I get to value area high up here, which happens to be also the initial balance high, I'm pausing here, and then there's a push. And then within that push, I can see some imbalances here. So I can see this here, which suggests, right, more aggression. Starting to see some look at the cum delta, right, as we're pushing the upper edge of the Bollinger Bands. There's real aggression here, taking this into the close, right? So there's the cash close here, the big, of course, right? We're always going to have a high volume on the 4 o'clock close, but signs of strength as the market is moving here. We're going to put this in full context here. Another imbalance here. The market comes back, wants to fill it, right, as it's prone to. This is unfilled, right? Unfilled fair value gap. Come back here, fill that efficiency, and then there's the last push. Now, again, are you trading in the last 15 minutes of the day? I wouldn't, but many people do, right? So again, that's just there's a lot of volatility right there. Maybe many people will wait for the market on close imbalances and see, maybe they can get a little squirt up there. That often you can. If somebody's trading here in the last 15 minutes of the day, it's usually you're trying to save your day, right? You want to make your money before Europe's close, right? Before 11:30. But if you're trading in the last 15 minutes, you're trying to save your day, and often. And I can speak from experience here. If you're trying to save your day in the last 10, 15 minutes to, turn a negative into a winner, all you're doing is likely making it worse. So just a word to the wise. Let me get this off out of here. Okay, all right. So hopefully what you're seeing is some benefit here. Again, here's another day, very tight, right? Big gap. Here's the opening range, right? No follow through. There's the IB high remains unbroken for the entire day. Here's the break of the low, the retrace, right? for the market to really accelerate past the initial balance highs or lows, there's news or something, there's a very strong trend or some data that came out. You'll note here, look how we come back to it and test, and then come back to it and test, and come back to it and test. So the IB low is at the same location as the opening range low. So you can see that resistance. It's the kind of thing, right? You wouldn't want to be blind to it. So this is a useful way to take the initial balance and then add into it another approach, right? The opening range breakout technique, and use it as it's potentially either a break, right? And then potentially support, right? So it's the same idea. Always the idea, the safest way to trade it is to wait for the retrace. Yes, we've broken the opening range. I don't necessarily want to just plow in at the market here. If there's a retest, that, in my view, is the trade. It's not this one. It's this one. Oh, we could do the same thing here and see what we look like here in terms of getting a 1-to-1. I'm just using this pivot high as we went back in and attempted to get back into the initial balance, because there's bulls will always want to see it get back into the initial balance. Bears will want to keep it out, right? So to see if they can get a trend established. So we get a little measured move here, right? A to B equals C to D. So is there a trade there? Well, yeah. Well, we could probably do something like this. All right, so what did you get? 2-to-1, right? You didn't quite get 3-to-1. Are you going to hold for this through that? Unlikely. But there's 2-to-1. Nothing to sneeze at. Okay, let's see if we can put this all together for those of you that would prefer it. So let me rephrase this. If you have the screen real estate, if you have multiple monitors, or you don't mind working with multiple tabs like this, it's not a bad thought to have the RTH session up as well. So you can look, again, it's just a visual clue. You don't need it though. Let's see what I've got here. This is, well, hang on a second. Here's another way you can look at it. Now, all I've done here is apply the native fair value gap indicator to an RTH session. Emphasize, again, I'm back to Friday here, emphasizing again that an alternate, if you didn't want to take advantage of the statistical data from the unfilled gap of the daily gap fill indicator, I'm going to get that wrong every time. On the daily gap indicator, if you didn't see the significance to that, you could just use the fair value gap indicator, because that's going to show you the gap, because it's going to treat the opening gap as a fair value gap, right? That's all it is. It's a gap. And in the same way that the market wants to come back and fill in the inefficiency that was created from the fair value gaps throughout the day, the same idea here. That's often why it will fill the opening gap, because it's an inefficiency in the market. Now, again, here with an RTH, you're losing the pre-market context. But for those of you that don't care about that, well, here's an alternative, right? And you start to see some of these locations that we've been referencing here in the context now where I'm adding the inefficiencies here to identify, to give this more significance. So when we come here, not only are we testing the opening range high, right, the 15-minute opening range high, we've got a fair value gap here that's being tested, right to the tick, right? It's not uncommon, right? So that's a clear rejection that leads to that. Now, ultimately, the best trade of the day is right here. It's the same thing. It's the same thing. It's right here. Right, so we've come up here. There's no follow through. Again, you see the lack of volume. You see the lack of aggressive buying up here. The market looks like it's going to roll over. Oh, this would be, let's do this right here. So if we use this pivot, or it's the advantage of having the fractals here, this would be, in smart money concept, market structure language, this would be a change of character, right? Because we don't get a break here. So this would not be a break of structure, it would be a change of character. So if we get the change of character here, which implies, right, change of character is an internal break of structure, that would imply that you would anticipate a retrace after that, right? So here's the break. Now we come back for the retrace. Well, what do? Right? We do that retrace right to the fair value gap here. Here's the fair value gap. The Ninja version, you can set it to show, to stay on until it's filled, or completely mitigated, or partially filled. So here in this case, we get a partial fill, which is why this continues to extend. It's not a bad indicator, right? It's just a freebie that comes with Ninja. So there's God, can that get any prettier? Right now, you might want to be waiting. You might wait. I would, right? I would wait until it got back inside the initial balance. Right? Here's the initial balance high. Well, here's a push outside. It's rejected. It's rejected inside this fair value gap. So maybe your entry would be closer to this bar here. So again, kind of the same idea as we looked at here. If I just took this here, maybe the stop here would be entry here. Well, we end up getting all the way down here. What are we doing here? We're filling the gap. So here's the retrace into the fair value gap, the imbalance right at the 9 EMA, coincidentally. And then down we go for 3 to 1. Now, you can do the same thing over here. Here's the big gap, right? Again, you can use this. Of course, you're losing pre-market. You're losing all that statistical analysis, but here's your gap. Here's your unfilled gap. Market comes down, wants to fill it. Right now, we've been through this a couple of days, right? Through a couple of days here, but you can see this over and over again. You see the same thing here. Here's your unfilled gap. Or pardon me, here's your unfilled gap. Then we go up, we go down, and then we go up again, and we're breaking through. Now, you got to be careful, right? Because that's a gap from the prior day's RTH session. It's not a continuation gap from the overnight, so that can be a little deceptive. That's why that can be tricky. You just have to have an awareness of that. So this, again, careful of that. It's just continuing this because it didn't break it. But coming back here, swing up. Now here's a little retrace as we go here. Again, these are opportunities you want to look for. If I push up higher, this was the day where we had, okay, here's the break, and then this was a good pump in the afternoon. Once we got outside of the opening range here, here's a retrace. We don't make this fair value gap, but then we get a couple of here. So this might have been a really nice location here. You probably use this as your stop. Here's an entry here as we come back to test that fair value gap. What do we get? 2 to 1 here. Oh, you're not going to get all of that. Let's be real with ourselves. Let me highlight that. So likely as this starts to come back down, maybe you got 1.5 to 1 right here. If we pull this over as to when you're likely going to want to get yourself out, right? If this comes down now, but so you of course always, right? One possibility here is that you've taken your stop to break even. Here, I can't do that with this particular version. So if you're up here, right, and you're 1.5, I'd like to think maybe you've tightened your stop a little bit, right? So likely you had a winning trade there. Are you going to get all of it? Unlikely. So let's be realistic. 1.5, right? We'll probably be happy with that. Again, counts. How many contracts are you trading? Awfully good with the 9-period EMA right there as well. I think, oh, geez, I'm already at 37 minutes. I was going to go through multiple markets here, but I think you get the idea. Here's a day where it has very little value. Right? Here's that day where we just had that D-shaped profile here. There's no value here until the very end of the day. We start to push here. We start to see, okay, signs of aggression here, inefficiencies. Bulls are in control, leaving fair value gaps. Here's the test of the IB high after it's broken. And then we go. Okay, with that, hopefully that gives you some ideas to test out. Reminder, all of our indicators, including the daily gap fill indicator as we're demonstrating here, and the initial balance, with the only difference being that I've set it to 15 minutes instead of 30. These are available for a trial, a 7-day trial. You could trial our QM Delta indicator, right? If you don't have one, right, I would encourage you to consider one. I find the Bollinger Bands really makes ours unique, right? It's very, very valuable. And then you could use our volume. I mean, this is how I would use it. I mean, this now, of course, I have the benefit of having all of our indicators, but I would still use it this way. The only difference here is I've added the market structure indicator, so it's going to have all the fair value gaps already built into it with the market structure dynamics, right? So here's that change. Here's that change of character I talked about, right? When we broke this, there's the break, retrace. It turns into a market structure shift. Again, more imbalances that the market seeks to fill as we go into the end of the day, and that's it's kind of the same thing here. That's the benefit of something like the market structure indicator, because it's guiding you through the market, through the breaks of structure and the retraces. Add in the fair value gaps. Now you've got a complete system here. This is Devil's volume. Note as we test it, once we get back into it, where do we go? We go right to market has strong tendencies, right? Here's the fair value gap from the morning. Where do we go? Where's that high? Right, we go right to it and then drift down to the close. Okay, so that should give you a few things to think about. Some different setups you haven't seen before. The unfilled gap indicator always, it's easy to forget about it, right? This is a great tool, and again, these stats here should be very, very informative to you in terms of decision making, whether or not you want to pursue. Or the idea, is this likely to fill that gap? Again, out of 9 days, 8 filled within a day. Okay, with that, I'll wrap up here. Just a reminder, you can trial all of these. You might trial this in conjunction with a Cume Delta or maybe the manual back tester. You can do some manual back testing on this yourself, right? But don't be easy on yourself. Be hard on yourself. Where would you get out, right? Ask yourself that. Okay, with that, I'll wrap it up here, and we'll catch you guys on the next one.